Have you ever wondered how a company like Mondelez can own Oreo, Ritz, Cadbury, and Toblerone and somehow keep them all from stepping on each other's toes? I mean, how do they all succeed? Well, the answer isn't magic. It's a really powerful discipline called strategic brand portfolio management. Let's dive into how the best in the business pull it off.
All right, so here's our game plan. First, we're going to talk about why managing a bunch of brands is pretty much a necessity these days. Then, we'll break down the classic Toyota-Lexus strategy. It's a masterclass. After that, we'll look at the internal tug-of-war between different managers. And finally, we'll open up the playbook of the undisputed champs of this game, Procter & Gamble.
So why is this so important, right? Why can't a company just create one massive, dominant brand and stick it on everything they sell? Well, the simple truth is, markets just don't work that way anymore. If you want to grow, you have to get a lot more sophisticated.
And this right here, this is the question that keeps executives up at night. As you get more successful, your customer base gets bigger, and then it starts to splinter. You get all these different groups with different needs, different budgets, different values. Your old one-size-fits-all approach just starts to feel, well, irrelevant. And, this isn't just a problem. It's a huge opportunity for smaller, focused competitors to jump in and serve those little niches way better than you can. So you have no choice. You have to evolve.
This brings us to what a brand portfolio strategy actually is. And the key word here, the most important word on the screen, is managing. This is not about just collecting brands like they're baseball cards. No, it's about actively curating them, making sure every single one has a specific job to do. The goal is to build a system where all the brands work together, like an orchestra, to cover the market and maximize value, without causing chaos or competing with each other.
So the bottom line is, this market fragmentation forces you to tailor your offerings. But, and this is the crucial part, for it to actually work, the differences have to be real. It's not enough to just slap a new label on the same old box. Each product needs to be totally distinct across the board. The product itself, the service that comes with it, the brand story, the price, even where you sell it. It all has to line up to create a unique story for a very specific customer.
Okay, enough theory. Let's look at a fantastic real-world example of this in action. Toyota ran into this exact problem when they decided they wanted to play in the luxury car space. Now, what is so brilliant about this is just how disciplined they were. Toyota didn't just make a fancier, more expensive Toyota. No way. They built an entirely separate experience from the ground up. The Toyota brand is all about reliability, value, everyday transportation. The Lexus brand? It's a promise of a complete luxury experience. And just look at how every single thing on this chart supports that difference. The price, the white glove service, even having totally separate dealerships. It all works together to build two incredibly strong brands that don't compete with each other at all.
This really gets at a core idea. A brand is like a rubber band. It can stretch, but it's not infinitely elastic. The folks at Toyota knew their brand was super valuable, but its meaning was tied to dependability. Trying to stretch that same name to also mean the height of luxury would have just snapped the band. It would have weakened the core Toyota brand, and nobody in the luxury market would have bought it. So they created Lexus to build a new identity from scratch, one that could feel authentic and prestigious without messing with the hard-earned trust people had in Toyota.
Okay, so this all sounds great, but how does a company actually manage this kind of complexity on the inside? Well, success usually comes from balancing the natural tension between two really important roles, the brand manager and the product manager.
Think of the brand manager as the guardian of the brand's soul. They're playing the long game. Their job is to ask the big questions like, what do we stand for? And if we put our name on this new thing, will it help or hurt us 10 years from now? They are the ones who have to make that tough Toyota Lexus call. Can we stretch our existing brand, or do we need to build a new one to protect the whole portfolio?
Then you have the product manager. They are laser-focused on the product itself. Their goal is to win today. They're thinking about sales, market share, and beating the competition right now. And for them, using a big, powerful existing brand is often the fastest, cheapest way to get a new product to market. Their challenge is to balance that short-term win against the long-term risk of watering down the brand, the very thing the brand manager is trying to prevent.
Now, if Toyota perfected the two-brand strategy, let's look at a company that turned this balancing act into a global empire. For more than 100 years, Procter & Gamble has been the absolute gold standard here.
Seriously, the history of P&G is the history of modern branding. It started way back with Ivory soap, which they marketed on one single clear benefit: purity. They were pioneers. They basically invented modern consumer research. And get this, they created the soap opera just to have a place to run their ads. This incredible legacy has led them to their modern, hyper-focused strategy of only building what they call leadership brands.
Their secret is an approach famously called a house of brands. Now, this is the opposite of a branded house, like Google, where you see the Google name on everything. At P&G, every brand stands on its own 2 feet. Tide, Crest, Pampers, Gillette, you probably know all of them, but you might not even realize they're all made by P&G. And that is completely on purpose. It lets each brand have its own unique identity without being watered down by the others.
And this is the genius of their system. It's how they avoid what we call cannibalization, basically having your own products eat each other's lunch. Just look at the laundry aisle. P&G has multiple billion-dollar brands right next to each other, and they all do great. How? Well, they target completely different needs. Tide is all about performance, getting out the toughest stains. Gain, on the other hand, is for people who care more about that amazing fresh scent. Same category, totally different customers, 2 distinct brands.
So, does this all actually work? Well, the numbers don't lie. The brands that P&G decides to keep and invest in aren't just successful. They are absolute monsters. Every single one of their core leadership brands pulls in over $1 billion in sales every year. That's the result of a portfolio that is carefully curated, not just randomly collected.
And they don't get there by accident. This is a tough, continuous process. It's like gardening. They build these billion-dollar brands, and then they ruthlessly focus their money and attention only on the ones with the most potential. But here's the key. They also prune. They've sold off more than 100 brands that weren't performing or didn't fit their strategy. And finally, they take these huge global brands and tweak them just enough to feel local and relevant in every single market.
And this quote from Alexander Chernev really just nails the whole idea. A brand isn't just a logo or a catchy slogan. It's a core part of the product itself. For it to really work, it has to be perfectly in sync with everything else. The price, the service, the design, where you buy it, to create one clear, powerful message for the customer.
So when you look at giants like Toyota and P&G, it all boils down to one fundamental question you should be asking yourself. Are your brands just a random collection of assets you happen to own? Or are they a cohesive, finely tuned strategic system where every single piece has a clear purpose and helps make the whole enterprise stronger? The best companies in the world have already answered that question.